Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at Rubico.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. Rubico, they operate in that energy and marine charter sector.
Yeah.
It's a tough space.
Very demanding, yeah. Typically high risk, high reward.
Exactly. But what's interesting here, and why we're talking about them, is how they're trying to smooth out those cycles with these really long-term contracts. It kind of changes the whole risk profile.
Okay, let's unpack that. Because looking at the latest financials, the first thing I see is, well, it looks like a headwind. They reported a 1% decline in revenue for the first half of 2025. For a growth company, a dip like that, even 1%, it suggests the market is, a bit tough right now.
That's true, and that's absolutely what the market has been nervous about. H1 2025 looks soft on the surface, but you really, really have to zoom out. This is a company that's seen, phenomenal growth. We're talking 95% revenue growth over the last 3 years.
95%?
Yeah. Their trailing 12-month sales are sitting at $24.4 million. Yeah. So that 1% dip is, it's just a small blip on a huge growth story.
And this is where it gets really interesting, right? Because even with that 1% revenue dip, their net income went up.
Up by 13%. That's a huge jump.
So how do you do that? How do you grow profits when your sales are slightly down?
It tells you everything about management. They're being aggressive on cost efficiencies. They're getting operational leverage. Specifically, they point to much lower interest and finance costs.
So they're just running a tighter ship.
A much tighter ship. They've proven they can squeeze more profit out of every dollar, even when the market's a little sluggish.
Okay, so operations are strong. But in this sector, efficiency only gets you so far. The real strength has to be in future bookings, right? That contracted backlog.
That is the whole story. It's their competitive moat.
And it's big.
It's massive. They have $120.8 million locked in. Just think about that. Their current annual sales are around $24 million. This backlog is 5 years worth of revenue.
Wow.
That gives them stability and visibility that their peers just dream of.
That visibility is key, but only if the price is right. Did they lock in good rates, or did they just sell contracts cheap to get the long-term deals?
Oh, they definitely got premium pricing. The rates are extremely attractive. Their gross daily hire is locked at $32,850 a day.
And for how long?
It's locked in solid until January 11th, 2027. So you have 2 years of guaranteed high-margin revenue right there.
That's a great short-term picture, but, the thesis needs to go beyond 2027. What happens then? Does it all just fall off a cliff?
See, that's the smartest part of how they structured these deals. After January 2027, they have a guaranteed rate of $29,990 for another 4 years.
So they're basically locked in through 2031.
All the way. And what's more, they built in upside options. So if the market gets hot, that daily rate could jump up to $34,000, even $36,000.
So they have a high floor and a really high ceiling. That's a critical detail. They're not just playing the spot market like everyone else.
Exactly. They're playing a completely different game. Which brings us to the elephant in the room, the balance sheet.
Right. We have to talk about it. Because all this growth potential, it doesn't matter if the company goes under.
And the debt is significant, $73.7 million in total debt.
And their cash position.
It's tiny.
Yeah.
Just over $500,000. So you're looking at a negative net cash position of over $73 million. That's a huge red flag for a lot of people.
It's an immediate turnoff for many investors, yeah.
It is, but you need the context. In a business like this, you need debt to buy the vessels, the assets that make the money. The real question is, can the cash flow cover the debt?
And with that $120 million backlog,
it becomes very manageable. They have fixed, guaranteed income to service fixed debt.
Okay, so how are they managing it right now? What are the active steps?
Management has been very proactive. They did a small $1.5 million private placement back in June to get some quick cash.
Okay.
But the big move was in July. They secured a $30 million equity line purchase agreement, an ELPA.
So for our listeners, what exactly is that? It's not a loan.
No, not a loan. It gives them the right, but not the obligation, to sell up to $30 million in shares over time. It's a safety net.
So it's all about flexibility. They can raise cash if they need it, when they need it, maybe when the price is better.
Precisely. And you notice there are no dividends, no buybacks. Every dollar they generate is going right back into managing that debt and securing the future. It's the only smart move right now.
That $30 million line,
Yeah.
that could also be a catalyst, couldn't it? It's not just a buffer.
Oh, absolutely. Think about it. If they use that for, say, an accretive vessel acquisition, buying a ship that already has a high-rate contract attached, it would just amplify everything we've been talking about.
It turns a defensive tool into an offensive one?
It could be a game changer. But now we have to talk about the real head-scratcher here, which is the stock chart.
Yeah. The technicals are something else. The fundamentals say stable, but the stock price is screaming crisis.
Crisis is the word. The stock has dropped a shocking 73% in the last month.
A 73% drop wiped out the entire year's performance. Why? What could trigger a reaction that violent?
You know, we have to speculate a bit. Was it a big fund being forced to sell? A rumor that didn't pan out? Or just the market panicking over that debt number combined with the slight revenue dip?
Whatever it was, it's crushed the valuation. The price-to-sales ratio now looks, absurdly low compared to peers, especially for a company with 95% three-year growth.
It's a classic case of the market pricing in only the fear and completely ignoring the guaranteed, locked-in future revenue.
So this looks like a capitulation bottom where pretty much everyone who was going to panic and sell already has.
That's what it looks like. And it sets up a potential for what we call bullish divergence.
And bullish divergence just means the stock price has fallen way behind the actual strength of the company.
Exactly. The price action has totally disconnected from the fundamental reality of that backlog. That $120 million is a backstop. It de-risks the downside. The stock is just oversold.
And we did see a small bounce recently, right?
Yeah, tiny rebound, about 0.86%. And it happened right on the news about those contracts. So the market is slowly starting to pay attention to the fundamentals again.
Okay, so let's summarize the risks and catalysts here. We need to be clear on the bear case because that 73% drop is terrifying.
For sure. The bear case is simple. It's that huge debt load, number one. If there's any operational hiccup with a charter or if interest rates keep climbing, that could pressure them. They have to manage it perfectly.
And number two is just the momentum, right? That 73% drop creates a huge wall of worry to climb.
It's a massive psychological overhang, absolutely. But on the other side, the catalysts are very specific.
The first one has to be earnings.
The very next quarterly report, expected early 2026. That's when we should really start to see that huge backlog flowing through to the income statement. That's where the story meets the numbers.
And it needs to prove the thesis. What about bigger picture, macro stuff?
The macro environment is actually pretty favorable. You see sector rotation into energy shipping when oil markets get volatile. And in that world, a company like Rubico, which is locked in those high daily rates, becomes a safe haven. That contract stability is gold.
Okay, let's tie it all together for you, the listener. What's the core thesis for Rubico right now?
It's a multi-year compounding story. It's driven by that huge locked-in backlog that gives them a clear growth path way beyond their peers. Yeah. The Bruegel market sell-off has created, a potentially attractive entry point, while those capital raises help buffer the debt risk.
So at the end of the day, what's the core decision an investor has to make here?
The decision is simple. Do you believe in the certainty of those contracts more than you fear the immediate balance sheet? It's about whether those guaranteed long-term cash flows outweigh the debt and the crazy price volatility we've seen.
Can you handle the short-term risk to get to that long-term fundamental certainty? A great question to think on. If you want to keep up with our analysis on companies like Rubico and more, make sure you hit that subscribe button before you go.